Have you ever looked inside a company and just wondered, how do they really make those big strategic decisions, the ones that shape their future?
Hmm.
It often feels like this mysterious, numbers-driven world,
Yeah.
hidden away in spreadsheets and boardrooms.
Yeah, very opaque sometimes.
But here's the thing. Finance isn't just about crunching numbers.
Yeah.
It's really the absolute beating heart of any organization. It's like this central nervous system dictating how resources flow, how value gets created.
Absolutely.
I mean, just try to imagine a business without money flowing, right?
Right.
Without funds being managed precisely or allocated strategically.
Impossible. Just couldn't function.
Totally impossible. So today, we're going to take a deep dive into this fascinating and, honestly, incredibly vital role of the financial manager.
Yeah.
It's a position that wears so many hats, from strategist to, well, even ethicist. We're going to peel back the layers today,
Sounds good.
uncover not just what financial managers do, but maybe the hidden forces in human decisions that really shape a company's destiny.
Exactly. And our mission here is really to unpack their core responsibilities. We want to understand their primary objective, what drives them,
Right.
and explore the complex challenges they navigate every single day. That includes ethical dilemmas, which are huge, and also this intriguing thing called the agency problem.
Okay, let's get to the pulse of it then. What's the fundamental goal? The thing that guides every single financial decision.
Hmm.
Because the conventional wisdom, you always hear profit is king.
Right.
But you're saying that's maybe not the ultimate star for a financial manager, is that right?
Yeah, you've really hit on a common misconception there. I mean, obviously, profit is important for survival, no question.
Sure.
But profit maximization, which we often measure using earnings per share or EPS, it really focuses purely on the bottom line.
Okay.
And that has some crucial limitations. For one, it often ignores the timing of cash flows, the difference between a profit on paper and actual cash in the bank.
Okay. When you actually get paid.
Exactly. Or when dividends truly land in shareholders' hands. It also doesn't really account well for risk, how actual results might differ from what you expected.
Yeah.
And we all know accounting profits can sometimes be influenced by, let's say, creative accounting,
Uh-huh.
which can prioritize short-term gains, like maybe cutting labor costs sharply, but potentially at the expense of long-term development or market position.
Right. Damaging morale or future innovation.
Precisely. Shareholder wealth maximization, though, that's generally seen as the superior objective.
Okay. Why is that?
Well, it's typically measured by the business's current share price. And that share price, that's the market's real-time assessment.
So what the collective wisdom thinks it's worth.
Exactly. And it inherently considers the market's expectations about both the timing and the size of future cash flows, plus the business risk involved. So basically, every financial decision a business makes should, in theory, positively impact that share price. The financial manager's key objective, then, is to only really consider projects and decisions that are expected to boost it, building lasting value.
That's a really strong argument. It forces a longer-term view, a more holistic perspective.
Mm-hmm.
I guess, though, some might wonder, are there downsides to focusing so much on share price? Could it accidentally lead to short-sighted moves, even with this broader view?
That's a fair question. I mean, chasing share price, if you don't have strong governance alongside it, could theoretically push managers to take on maybe too much risk
Right.
or focus only on what gives an immediate market reaction rather than truly sustainable innovation.
Okay.
But generally, a well-informed market tends to reward consistent long-term value creation. The goal isn't just, a quick spike in the stock price.
Right, not just a sugar rush.
No, it's about a sustained upward trend that's built on solid business fundamentals.
And we've actually got a great real-world example of this with GlaxoSmithKline, GSK.
Yeah.
Back in 2011, this huge pharmaceutical company announced a new strategy. They called it their financial architecture.
Okay, financial architecture. Sounds impressive.
It does. And it wasn't just about chasing the highest possible accounting profit. They were strategically trying to build value right into their operations.
How so?
Well, their strategy explicitly aimed to increase their operating margin and drive more cash flow from sales growth,
Okay.
which would then fund things like potential share buybacks, reinvestment back into the business, and of course, dividend payouts.
So linking operations directly to shareholder value?
Exactly. They had specific goals,
Mm-hmm.
like 4% average annual sales growth, actively managing their costs to boost operating profit.
Mhm.
And even strategically reducing their tax rates, they aim to get from 27% down to 25% by 2014.
Interesting.
And here's a really fascinating detail. They focused heavily on their cash conversion cycle.
Okay, what's that?
They wanted to cut it down from 244 days back in 2009 to a much leaner 210 days in 2011.
Right, and for those maybe not deep in treasury, could you just quickly explain what shortening that cycle actually means for a company like GSK?
Absolutely. Yeah, good point. It basically means they're turning their investments, things like inventory and what customers owe them, back into cash much faster.
Getting the money quicker.
Exactly. Think of it as how fast they convert their inputs and sales back into ready cash. A shorter cycle frees up capital, lets them use it for other things, and it signals better operational efficiency.
Which the market loves.
Precisely. All things the market would reward, ultimately boosting that share price.
Makes sense.
So, okay, that core mission, maximizing shareholder wealth, that's clear. But how does a financial manager actually do that day to day?
Yeah, the practicalities.
Right. Which brings us to the huge scope of their responsibilities. And it's worth noting, these roles can look quite different depending on the size of the business, right?
Oh, absolutely. In smaller businesses, the financial manager often has to wear many, many more hats.
Juggling a lot.
Definitely. But the primary responsibilities, the ones common to pretty much all financial manager roles, can be grouped into three main areas.
Okay.
Financial planning and analysis, usually called FP&A, then investment decisions, and finally, financing decisions. These are really the pillars of financial strategy.
Okay, let's start with FP&A. That sounds like more than just crunching numbers. It's about, like, making the future visible.
That's a good way to put it.
So what's maybe the biggest mistake businesses make with their budgeting process that a really good financial manager would spot instantly?
That's a great question. A really common pitfall in FP&A, which covers both forecasting and budgeting, is treating them as these static, once-a-year things you just do and file away.
Set it and forget it.
Exactly. When really, forecasting uses historical data and current trends to project where the business is actually heading. It's often updated maybe 3 times a year, quarterly, to reflect changing conditions.
Like adjusting the sales based on the current wind.
Perfect analogy. Think of forecast 1 having maybe 3 months of actual results and 9 months of expected data, and so on. A budget, on the other hand, that's your financial roadmap for the next fiscal year. It's usually prepared in the last quarter of the current year.
The plan for next year.
Right. The mistake is often not dynamically linking the two, or not using those updated forecasts to actually course correct the budget during the year if things change.
Got it. And the other part of FP&A.
That's coordination and control. This involves rigorously monitoring the financial performance, comparing actual results not just against last year, but crucially against those forecasts and the budget.
Okay, tracking progress.
Yes, and using tools like ratio analysis to spot variances, figure out why they're happening, and pinpoint where you might need to take corrective action. A top financial manager doesn't just report the numbers. No, they tell the story behind the numbers and, importantly, propose solutions.
Okay. Actionable insights.
Exactly. Then we move to investment decisions. Now, this isn't just about spending money. It's about strategically putting capital where it's going to generate the best possible returns.
Right. Where do you place your bets?
Precisely. What are the major distinctions here? Well, this is where the financial manager really shapes the future of the business. It's about making sure funds are there when you need them, and crucially, deciding where to allocate that capital for the biggest impact.
Right.
We usually split this into 2 time frames. Short term, it involves working capital management,
Meaning.
optimizing that tricky balance between inventory, what customers owe you, trade receivables, and what you owe suppliers, trade payables. It's about keeping the daily operations smooth and liquid.
Even the wheels turning.
Exactly. Then for the medium and long term, it's about rigorously assessing potential projects, using sophisticated tools like net present value, NPV, discounted cash flows.
The heavy-duty analysis.
Right. For planned investments in non-current assets, the big stuff. This could be anything from launching a new product line, investing in new factories or equipment, funding R&D.
Big marketing campaigns.
Yep, major marketing pushes, or even big strategic moves like mergers, acquisitions, or selling off parts of the business, divestments. It's about picking the right long-term battles for growth.
Okay, so once you've figured out what great things you want to invest in, the next big question is, how do you pay for it all?
The million-dollar question, or often multi-million-dollar question.
Right, which brings us to financing decisions.
Precisely. This is all about figuring out the company's capital structure, Basically, how the business strategically funds its activities.
So where does the money come from?
Broadly, you've got two main routes. Debt financing, which means borrowing money, typically from banks or other financial institutions.
Okay, so
Yep. Or equity financing, which involves issuing shares, selling ownership stakes to investors. And a really key, often overlooked part of this is the skill of financial negotiation. Talking to those banks and investors to secure the best possible terms for the business. It's a careful balancing act involving risk, the cost of that capital, and how much control you might give up.
Wow, okay, so FP&A, investment, financing, those are huge areas already.
They are full-time jobs in themselves, easily.
But you mentioned there are other vital roles too.
Yes, beyond those core three, financial managers often handle several other critical responsibilities. Things like cash management, relationship management, dividend decisions, and risk management.
Let's touch on cash management. It sounds simple, just manage the cash, but it's absolutely crucial, isn't it?
Oh, fundamental. It's not just about having some money in the bank. It's about making sure there's always enough cash for daily operations. Working capital, paying back loans, making payroll, keeping the lights on.
The essentials.
The absolute essentials. But it's also about ensuring those funds are being used optimally. You don't want large amounts of cash just sitting idle when it could be earning a return somewhere.
Right, making the cash work for you.
Exactly.
And then there's relationship management. You mentioned fostering connections, not just with banks and investors, but with a whole range of stakeholders.
Yeah.
What's the main challenge in juggling all those different interests?
That's a fantastic point, and it's a real challenge. The financial manager needs to build and maintain strong relationships across the board. On one side, you have the financial markets, banks, brokers, investors, regulatory bodies like the SEC. Their trust directly impacts your access to capital and how the market values your company.
Crucial.
Absolutely. On the other side, you have all these diverse stakeholders. These are individuals or groups with a direct or indirect interest in the business.
Like who?
Well, think about it. Shareholders obviously want a return on their investment, maybe dividends. Creditors, like banks, care about your creditworthiness. Can you pay back your loans?
Makes sense.
Employees want job security and fair pay. The government wants its tax revenue. Customers rely on the business being stable. Even the local community might have an interest in the company's contribution to the local economy.
Wow, that's a lot of different groups with potentially different priorities.
Exactly. The challenge is balancing these often competing interests. Keeping those relationships positive is essential for the long-term health and reputation of the business. It's really about building bridges, not just, counting the dollars.
That makes sense.
Yeah.
Then you mentioned dividend decisions. So after all the strategy, the investing, the operations, how much of the profit actually gets shared back with the investors? It sounds like a bit of a tightrope walk.
It absolutely is. It's a constant balancing act for the financial manager. How much profit should we keep and reinvest back into the business for future growth?
Right.
Versus how much should we distribute right now as dividends to our shareholders? This decision has a big impact on cash flow, obviously, but also critically on investor relations and how the market sees the company.
Yeah, I can see that. Retain too much, maybe investors get impatient.
Potentially. Distribute too much, and you might starve the company of funds needed for future growth or opportunities.
Tricky balance.
Very.
And finally, risk management. Businesses face all sorts of risks, right? Operational, strategic, financial. What's the secret to finding that sweet spot, that optimal risk tolerance?
Well, the secret, if there is one, is understanding that risk isn't automatically bad. It's more like a spectrum.
Okay.
Financial risk, for example, is basically the possibility of losing money on an investment or a venture. But generally, higher risk comes with the potential for higher returns, and vice versa.
The classic risk-reward trade-off.
Exactly. The financial manager's job is to figure out the optimal level of risk tolerance for this specific business, aligning it with the company's overall strategy and goals.
So it's not one size fits all.
Not at all. It's a continuous process, analyzing all the potential risks the business faces, figuring out how likely they are and what the impact could be, and then deciding how to respond. Do we try to avoid the risk altogether, mitigate it, reduce its impact, or just accept it as a cost of doing business?
Interesting.
What's really fascinating is how they actively try to anticipate potential problems and build in safeguards to protect the business's future, its longevity, and profitability. It's like playing, high-stakes chess, always trying to think several moves ahead.
That's a great analogy. Now let's shift gears slightly, because as we've hinted, it's not just about numbers and strategy, is it?
No, not at all.
It's also about trust, about human behavior, the very foundation, really, on which all of these financial decisions are built.
You absolutely hit the nail on the head there. Ethical considerations are completely non-negotiable in financial management.
Right.
Ethics in finance, basically, are the moral norms that must be applied in financial activities. Things like ensuring fairness and transparency in loan agreements, or in how you report financial results.
A basic honesty and fairness.
Fundamentally, most financial managers are also required to follow a strict ethical code set by a professional body. You mentioned the IPFM in South Africa. There are similar bodies globally.
Okay.
And maintaining high ethical standards isn't just nice to have, it directly builds a stronger business reputation in the market and with all those stakeholders we talked about.
Trust is key.
Absolutely. That's why so many organizations have mandatory ethical policies and training now. Often, employees have to formally sign off each year saying they understand and will comply.
Right. And ethically, what are the key impacts a manager needs to think about?
Well, when making decisions, they have to constantly consider the impact on shareholder rights, making sure they're never violated.
Okay.
This also links back to that idea of mutual shareholder wealth maximization, meaning, no single shareholder or group should benefit unfairly at another's expense.
A level playing field.
Exactly.
Yeah.
And of course, maintaining those strong ethical relationships with all stakeholders is paramount.
And to make this really concrete for everyone listening, consider something like the advisory board company's code of ethics for their finance team members.
Okay.
It really highlights core principles like unwavering loyalty to the company, strict compliance with all the laws and regulations, adherence to high ethical standards demanding honesty and fairness in every single dealing.
The basics.
The absolute basics, but crucial. It also emphasizes things like accurate record keeping, actively avoiding conflicts of interest, not using company opportunities or information for personal gain,
Right.
maintaining absolute confidentiality about non-public information, and really importantly, actively encouraging people to report unethical behavior without any fear of reprisal.
Creating a safe environment to speak up.
Exactly.
Yeah.
So what does this all mean day to day? It sounds like constant vigilance, adhering to a really strict moral compass.
It truly is. And this brings us very neatly to a related critical concept.
Yeah.
The agency relationship and the potential for an agency problem.
Okay, break that down for us.
Sure. The agency relationship is simply how shareholders, who are the owners, delegate authority to managers to run the business for them.
Right, the managers act as their agents.
Exactly. In theory, the financial manager acts solely in the owner's best interest, which we've established is generally maximizing shareholder value.
Okay, sounds good in theory.
But theory and practice don't always align perfectly. The agency problem arises when the financial manager's personal objectives, things like maybe boosting their own personal wealth through big bonuses, or just making their own job more secure, aren't perfectly aligned with the shareholders' interests.
So their goals diverge.
Potentially, yes.
And this idea of asymmetric information kind of throws a fascinating wrench into the works here, doesn't it?
It really does. Explain that a bit.
Well, managers, being inside the company day to day, often have way more detailed information about the business, its performance, its prospects, its problems, than the shareholders outside do.
Right. The information isn't symmetrical.
Exactly. Which makes it incredibly difficult for shareholders to be absolutely certain that the manager is always acting in their best interest. And this information gap can lead to problems. Maybe a manager takes on excessive risk, chasing a huge personal bonus, even if it jeopardizes the company's long-term stability.
Yeah, betting the farm for their own gain.
Or the opposite could happen. A manager might become overly risk-averse, maybe because they're insecure about their job or want a promotion, and they pass up good investment opportunities that would have actually benefited shareholders.
Playing it too safe. Both are potential problems stemming from that misalignment.
So how do companies try to fix this? How do they bridge that gap and align those interests?
Well, one common approach is using performance-related reward schemes. Things like salary increases or bonuses that are directly tied to achieving specific financial targets or metrics.
Pay for performance.
Essentially, yes. And these schemes definitely have advantages. They can help attract really qualified people. They can powerfully motivate teams. They might increase employees' willingness to tackle difficult or challenging tasks, potentially lead to cost savings through improved efficiency, and, of course, directly help achieve those key financial goals.
Sounds good.
Yeah.
But there must be downsides too.
Oh, absolutely. they come with inherent disadvantages as well. For instance, employees might focus only on the rewarded tasks and neglect other important things that aren't measured.
Tunnel vision.
Exactly. People whose roles don't offer big rewards might become demotivated. These schemes can sometimes foster unhealthy internal competition rather than collaboration. And designing, implementing, and maintaining these schemes effectively can actually be quite costly and complex. It's definitely a double-edged sword that needs very careful calibration.
Right. It's not a simple fix.
Far from it.
And just to provide a really stark cautionary tale about what can happen when these ethical boundaries get crossed and the agency problem runs rampant,
Right.
we only need to look at the Steinhoff International Holdings case.
Oh yeah, a huge one.
Massive global retail company. Its share value just plummeted back in 2017 because of enormous accounting irregularities.
Billions wiped out.
Exactly. The CEO, other executives, they were accused of intentionally inflating the company's value, actively hiding how much financial trouble it was really in, using fraudulent accounting entries.
A deliberate deception.
It appears so. And the outcome was just devastating. The company lost something like $100 billion in value, and its share price dropped over 60% in just one day of trading.
Incredible.
It's just a powerful, tragic reminder of the catastrophic consequences when personal gain overrides shareholder wealth and basic ethical conduct.
A very sobering example.
So, wow, we've covered a lot of ground today. We've taken quite a journey.
We have indeed.
From really understanding that core objective, maximizing shareholder wealth, which is much more nuanced than just maximizing profit, to exploring all those diverse responsibilities of financial managers. We looked at strategic planning, investment, financing.
Relationship management, dividends, risk.
It's exactly. Navigating complex relationships, making those tricky dividend calls, expertly managing risk.
Yeah.
It's a huge remit.
And throughout, we've really seen how absolutely critical ethics are. Robust internal controls, properly structured incentives. They're all essential to ensure financial managers consistently act in the best interest of the business and its shareholders.
Right.
Diligently guarding against those very real dangers of the agency problem.
So after all this discussion, what
Yeah.
does this all mean for you, listening in?
Well, maybe something to ponder is this. What responsibility does each of us, whether we're consumers, employees, maybe investors ourselves, have in trying to understand the intricate financial architecture that underpins the companies we interact with every single day? And how
Yeah.
could that knowledge actually empower us and inform the choices we make in the marketplace?